Welcome to the deep dive. Our mission today is, well, it's a really crucial one for anyone tackling financial reporting. We're going deep into two accounting standards. They seem miles apart sometimes, but honestly, they're boundaries. They get tested constantly in the exam room.
They really do.
We are talking about IAS 2, which is all about standard inventory,
Yeah.
goods on the shelf for the factory, and then IAS 41, which deals with agriculture, living things.
And it's fair to say these two represent one of the biggest sort of conceptual clashes in financial reporting. You've got the historic cost model, driven by prudence, conservatism.
Right, the traditional way.
Yeah, versus the fair value model, which is all about relevance, showing the current value. And for you, the listener, look, you need to get beyond just memorizing definitions here.
Definitely.
This deep dive, it's really designed to get that conceptual clarity so you can apply the rules logically, break down those sometimes complex calculations and really secure the maximum marks. It's about understanding why.
Absolutely, because the devil really is in the details, isn't it? Especially understanding where one standard stops and the other one kicks in, and why the valuation methods are just so dramatically different.
That's the key.
So our mission today, let's break it down. It's threefold. First, we'll unpack the core principles of IAS 2, including some of those tricky calculations. Then we'll tackle IAS 41 and that, radical shift to fair value. And finally, we'll clarify that absolutely critical boundary line, especially dealing with that bearer plant exclusion. That one trips a lot of people up.
It certainly does. It's a classic exam area.
Okay, so let's unpack this first one, IAS 2. We're starting in the world of, say, the manufacturer, the retailer, the normal stuff, and the central foundational rule of IAS 2. It's immediately tied to one of the most important concepts from the conceptual framework. Prudence.
Absolutely prudence, or conservatism as some might know it. Basically, inventory has to be measured at the lower of its cost and its net realizable value, NRV.
Lower of cost and NRV. Got it.
And this really is the embodiment of prudence, isn't it? It demands caution. So in simple terms, it means we have to anticipate potential losses and recognize them immediately, straight away.
But not gains.
But never anticipate gains. We wait. We defer recognizing any profit until the sale transaction is actually complete and certain.
Okay, so let me get this straight.
Right.
If I'm holding inventory, say finished goods, and the market value suddenly tanks, the price drops. I feel that pain immediately. It hits my profit and loss.
Instantly. It goes straight to your statement of profit or loss, the SPL,
Yeah.
usually by increasing your cost of sales.
Okay. But if the market value doubles, if my inventory is suddenly worth way more.
You wait. You don't get to recognize that increase, that gain, until you actually sell the goods. Prudence holds you back.
Right. So if the net realizable value, the NRV, is lower than what the inventory cost me, that difference is an immediate write-down.
That's precisely the mechanism. It's an expense recognized instantly. And this stops companies from, presenting an artificially high asset value on their statement of financial position, their SFP, if realistically they're not going to get that value back when they sell it. It keeps a balance sheet honest in a way.
Makes sense. Keeps things grounded in reality. Hashtag 1.1, defining cost. The necessity test and cost formulas.
So before we can even do that lower of comparison, we've got to be crystal clear on what cost actually includes. It's not just the purchase price.
Right, it's broader than that. IAS 2 is quite specific, isn't it? It says cost includes all costs you incur in bringing the inventory to its present condition and location.
Exactly. And the key thinking here is what we often call the necessity test. Was this cost necessary to get the item ready for sale and where it needs to be?
Okay, necessity test. So what falls under that?
Well, the obvious ones are direct materials, direct labor. You can't make something without those. But critically, it also includes an allocation of manufacturing overheads, costs related to the production process itself.
Like factory rent or depreciation of factory machinery.
Precisely. If a cost was necessary for production or to get the inventory items to their current location, you capitalize it. It becomes part of the inventory asset value on the SFP.
Okay, let's use the sources example 1 here just to make it really concrete. Focusing on inclusions first. They mention carriage inwards and depreciation of factory plant.
Right. Carriage inwards, the cost of getting raw materials delivered to the factory, that's clearly necessary, isn't it? The materials can't be used if they don't arrive, so included.
Makes sense. And the depreciation of the factory plant.
Same logic. That plant, those machines, they're essential for the manufacturing process. Their depreciation represents the cost of using them up to make the goods. It's a production overhead directly contributing to the inventory's present condition, so included.
Okay, that's clear. Now, what about the common exclusions, the things that don't get included in cost? The example mentions general administrative overheads and carriage outwards. I know students often want to throw everything in.
Yeah, it's a common mistake,
Yeah.
but they fail that necessity test for inventory valuation. Think about general admin overheads like, say, the cost of the head office, the finance department, the CEO's salary.
Important cost for the business, obviously.
Of course, but are they costs of bringing this specific unit of inventory to its current condition and location? No. They relate to running the business as a whole, their period expenses, hitting the SPL directly.
Okay. And carriage outwards. The cost of delivering finished goods to the customer.
That's a selling cost. It happens after the inventory is finished and ready for sale.
Yeah.
It's about the sale transaction, not about getting the inventory ready. So excluded from inventory cost, it goes into selling and distribution expenses instead.
Got it. Stick to that necessity test. Was it needed to get it here and get it ready?
That's the mantra.
Okay, but sticking with cost.
Mm-hmm.
Even once we know what costs to include, there's another challenge, right? When you've got identical items bought at different prices moving in and out, how do you assign the cost to the units you sold versus the units still in the warehouse?
Ah, yes, the cost flow assumption. Because, unless you're selling very unique items, you probably can't tell which specific unit you bought in January versus February.
Like barrels of oil or sacks of flour.
Exactly. They're often indistinguishable. So IAS2 allows you to use a systematic formula. The two main ones permitted are FIFO, first in, first out.
And AVCO, weighted average cost.
Correct. FIFO assumes the first units you bought are the first ones you sell. So the cost of goods sold reflects the older costs, and the inventory left on the SFP is valued at the more recent, possibly higher costs.
Which might inflate profit a bit in times of rising prices.
Potentially, yes, in the short term, because you're matching older, lower costs against current selling prices. But the SFP value is arguably closer to current replacement cost.
Okay, and AVCO, the weighted average.
AVCO smooths things out. You typically calculate a new average cost every time you make a purchase, or sometimes just periodically, like at the end of the month. It averages out the price fluctuations.
So which one should a company use?
Well, the standard says you should choose the method that most closely reflects the actual physical flow of the goods, if possible. But consistency is key. You choose one and stick with it. However, there is an exception. If the inventory items are not interchangeable, like unique pieces of art or custom-built machinery, then you must use specific identification. You track the actual cost of each specific item.
Right, that makes sense for unique items. And one really crucial point here, a big no-no under IAS2.
Ah, yes. LIFO, last in, first out.
Strictly prohibited, isn't it?
Absolutely banned under IFRS. The logic against it is that LIFO often leaves the oldest, potentially very understated costs sitting on the statement of financial position while matching the very latest, maybe highest costs against revenue. It can really distort the SFP value and doesn't usually reflect how goods physically move. So no LIFO. Hashtag tag 1.2.
Yeah.
The critical nuance of overheads and capacity, example 2 scenario.
Okay, now here's where I think the complexity really ramps up. And it's a place where, honestly, a lot of students get tripped up. It's about how we handle those fixed manufacturing overheads, like the factory rent or depreciation we mentioned, especially when production levels go up or down.
Yes, this is absolutely critical. It's governed by what's called the normal output rule.
Normal output.
Right.
You can't just take your total fixed costs for the month and divide them by however many units you happen to make, can you?
No, you absolutely can't. Think about why. If you could do that, imagine a factory has a really slow month, produces hardly anything. If you spread all the fixed rent and depreciation over just a few units, the cost per unit would rocket sky high.
And that would inflate the value of the inventory sitting there.
Exactly. Management could potentially manipulate profit just by producing inefficiently or overproducing. To stop that, IAS2 says you must allocate fixed manufacturing overheads based on normal levels of production activity.
And how do we define normal output? Is it just last year's number?
Not necessarily. It's defined as the production level expected to be achieved on average over a number of periods or seasons under normal circumstances. Importantly, it takes into account the loss of capacity from planned maintenance or expected downtime. It's meant to be a sort of steady, efficient level of output.
Okay, an average sustainable level.
Precisely. Let's make this real with the scenario in example 2. It says a company incurred total fixed production overheads of $72,000 for the year.
Okay, $72,000 total fixed cost.
And this cost was budgeted based on a normal output level of 12,000 units.
Right. So the standard fixed overhead absorption rate, The rate we must use to value the inventory should be calculated using that normal level. So $72,000 divided by 12,000 units.
Which comes out to $6 per unit.
Okay, $6 per unit is the overhead cost that gets attached to each unit produced for inventory valuation purposes.
That's the rate you capitalize. Now, the scenario throws in a curveball. It says maybe due to industrial action or some other issue, they only actually produced 10,000 units during the year.
So actual production is below normal capacity.
Yes. So what happens now? They only produced 10,000 units. Using the correct $6 rate, how much fixed overhead actually got absorbed into the cost of inventory?
Well, 10,000 units times $6 per unit. That's $60,000 absorbed.
Correct. But wait, the company still had to pay the full $72,000 in fixed costs, didn't they? The rent, the salaries?
Yes, they did. So there's a shortfall. They incurred $72,000 but only put $60,000 into inventory value. What happens to that remaining $12,000?
That $12,000 difference represents unabsorbed fixed overheads. And this is the key point. It cannot be capitalized into inventory. It's treated as an abnormal expense or loss for the period.
So it bypasses the inventory account entirely.
Entirely. It must be expensed immediately to the statement of profit or loss. You're essentially recognizing the cost of the idle capacity or inefficiency in the period it happened.
Okay, so the journal entry might be something like a debit to cost of sales, or maybe a specific underabsorbed overheads expense line in the SPL for $12,000.
Exactly. And a credit to the relevant overheads control account, or may directly reducing the expense recognized elsewhere. The point is, it hits the P&L now.
And that stops the cost per unit of those 10,000 units from being artificially inflated by the poor production level. Each unit still only carries the $6 of fixed overhead based on normal activity.
Precisely. The $12,000 is seen as a cost of the factory not working efficiently, not a cost of making the actual inventory produced.
That makes sense. It prevents smoothing profits by just fiddling with production volumes.
Yeah.
What about variable overheads, though? Things like power usage that goes up and down directly with production?
Good question. The normal output rule only applies to fixed production overheads. Variable overheads, by their nature, vary with actual production. So you just allocate the actual variable overheads incurred across the actual units produced. No normal capacity adjustment needed for those.
Okay, fixed overheads use normal capacity. Variable overheads use actual capacity. Got it. What if the company had a really good year, though? Say normal capacity was 12,000 units, fixed overhead $72,000, 6 unit, but they actually produced 15,000 units.
The case of overabsorption. They produced more than normal.
So they'd absorb $6 times 15,000 units, which is $90,000, but they only actually spent $72,000 on fixed overheads. Can they capitalize $90,000?
No. You still use the $6 per unit rate based on normal capacity for costing each unit, but the total amount capitalized cannot exceed the actual fixed overhead cost incurred. So in this case, you'd still only allocate the $72,000 across the 15,000 units.
Which means the fixed overhead cost per unit for that specific period would actually be less than 6. 72,000, 15,000 units equals $4.80 per unit?
Correct. The principle is you never allocate more fixed cost than was actually incurred. The normal capacity rule primarily acts as a ceiling to prevent capitalizing inefficiency when production is below normal.
Okay, that's clear. Now that example 2 also mentioned something else. 200 units were damaged due to poor storage during the industrial action. Is that related to the capacity issue?
No, that's a separate kind of loss. This is about abnormal waste or spoilage. It's not about efficiency levels. It's about specific units being damaged or destroyed beyond normal expectations.
And how do we treat those costs?
These abnormal losses are expensed immediately in the period they occur, regardless of production levels. You take the cost attributed to those damaged units out of inventory and charge it straight to the SPO. Let's say the full cost per unit, calculated correctly using the $6 fixed overhead rate, was $11. Materials $3 plus labor $2 plus fixed overhead $6.
Okay, $11 cost per good unit.
Then the cost of those 200 damaged units, which is $2,200, 200 buys $11, must be removed from the inventory asset value and expensed. Debit expense, SPL, credit inventory, SFP, unless those damaged units still have some value, some net realizable value. Which brings us very neatly to the next step, the NRV test.
Right, so based on example 2, the cost per unit for the good inventory, the ones that weren't damaged, is $11. Now we have to compare that $11 cost figure against its net realizable value. Hashtag tag 1.3, defining net realizable value, NRV.
Exactly. The comparison to NRV is the crucial second half of that core IAS 2 rule, lower of cost and NRV. It answers the really practical question. What cash can we realistically expect to generate from selling this inventory in its current state or after finishing it?
And the calculation, just to recap, is the estimated selling price in the ordinary course of business,
Minus any estimated costs needed to complete the goods if they're a work in progress.
and minus any estimated costs necessary to actually make the sale, like delivery or commission.
Spot on. And notice the key words there, estimated and ordinary course of business. We're looking at normal selling prices, not a forced fire sale or liquidation price. And these are estimates, so management judgment is involved.
Okay, let's apply this. Starting with those 200 damaged units from example 2, we worked out their cost was $11 per unit. The example says they can probably still be sold for $12 each, but they need minor repairs costing $2 per unit first.
Right. So for these damaged units, let's calculate the NRV. Estimated selling price is $12. Estimated cost of completion, the repairs, are $2. Are there any other selling costs mentioned?
Doesn't look like it for these specific ones.
Okay, so NRV equals $12 selling price, $2 completion costs equals $10 per unit.
Okay, NRV is $10. Now we compare. Cost is $11, NRV is $10. We have to choose the lower value.
Which is $10. So we must write down those 200 units from their cost of $11 to their NRV of $10.
That forces an immediate write-down, a loss recognition of $1 per unit. For 200 units, that's a $200 loss in total.
Correct. And how do we record that $200 write-down?
It needs to hit the P&L, right? So debit cost of sales or maybe inventory write-down expense for $200.
And credit the inventory asset account for $200, reducing its carrying value on the SFP. That's the mechanism. The loss is booked now, reflecting the reduced economic benefit we expect.
Okay, let's look at example 3 now. Inventory A is work in progress, WIP. It's cost $2,500 so far. It's expected to sell for $280 per item when finished. But there are direct selling costs of 5% of that selling price, and it still needs $10 per unit spent on it to actually complete it.
Right, this is a good one because it brings in both completion costs and selling costs into the NRV calculation. Let's assume, say, there are 10 units of this WIP just to have a number.
Okay, 10 units. So the total expected selling price would be 10 times $280, which is $2,800.
Good. Costs to complete are $10 per unit, so for 10 units, that's $100 needed to finish them.
Right, and the selling costs are the 5% of the selling price. So 5% of $2,800, that's $140. These might be sales commissions or specific delivery costs, perhaps.
Exactly. So now we calculate the NRV for inventory A. $2,800 selling price minus $100 completion cost minus $140 selling cost.
Okay, $2,800, $140, $2,560. That's the NRV.
Now compare. Cost is $2,500. NRV is $2,560, which is lower.
Cost is lower, $2,500.
So inventory A is valued at $2,500. No write-down needed here. Even after spending the money to finish and sell it, we expect to recover more than its current cost. The $2,500 carrying amount is justified.
Okay, now let's flip it with inventory B. This costs $10,000. It's got damaged packaging. To sell the 1,000 units, they need to spend $2,000 on repackaging. After that, they reckon they can sell them for $11 each. Let's assume no other selling costs beyond the repackaging for this one.
Okay, cost is $10,000. Let's find the NRV. The estimated selling price is 1,000 units times $11 each, which is $11,000.
Right, and the costs to complete or make ready for sale are the $2,000 for repackaging.
So NRV is $9,000. Now compare again. Cost $10,000, NRV $9,000. Lower is.
NRV at $9,000. So we must write down inventory B from its cost of $10,000 to its NRV of $9,000.
That's a mandatory loss recognition of $1,000.
Exactly. And the journal entry would be debit cost of sales, or the write-down expense, $1,000, credit inventory, $1,000.
Perfect. And that ensures the inventory on the balance sheet isn't overstated. It's shown at the amount the company realistically expects to recover.
Makes complete sense. It's all about not overstating assets and recognizing losses quickly.
That's the heart of it. And one final important nuance on NRV write-downs. What if, in the next accounting period, the situation improves? Say, the market price for inventory B recovers, or they find a cheaper way to repackage it so the NRV goes back up above the original cost.
Can you reverse the write-down?
Yes, you can, and in fact, you must reverse it if the circumstances change. The reversal is credited back to the SPL, usually reducing cost of sales, making profit higher in that period.
So you get the benefit back if the value recovers.
You do, but, and this is crucial, the reversal is limited. You can only reverse it up to the point where the inventory is back at its original historical cost. You can never write inventory up above its original cost under IAS 2.
Okay. So prudence still caps the upside. You recognize the loss immediately, you recognize the recovery if it happens, but you never recognize an unrealized gain above the initial cost.
Precisely. The historical cost remains the ceiling.
Right. That feels like a pretty comprehensive run-through of the key principles of IAS 2. It's a standard built entirely, really, on those conservative ideas. Prudence, careful cost allocation, recognizing losses now.
Very much so. Historical cost is king, tempered by the NRV safety net.
Okay, so now we're going to take these accounting concepts, drive them out of the factory onto the farm, and basically flip the rulebook completely. Because IAS 41 agriculture introduces a radically different approach.
Yeah, get ready for a big shift in thinking.
Right, so we're shifting gears dramatically. We're moving from the, let's say, controlled environment of a factory floor or warehouse into the often much more volatile, growth-dependent world of agriculture, animals, plants.
Living assets.
And moving to IAS 41 means a major conceptual shift. We're largely throwing out historical costs and embracing fair value instead.
That's the headline news for IAS 41. When you're dealing with what the standard calls biological assets, basically, living animals or plants, the rule is measurement at fair value less costs to sell, FVCTS.
Fair value less cost to sell.
Okay, and historical cost. For the most part, it becomes irrelevant pretty quickly after you first acquire or recognize the asset. Sometimes it's not even used for the initial measurement if a fair value is readily available then.
But why? Why this radical departure? I mean, surely we could track the cost of feed for cattle or water for crops, vet bills. That seems prudent, like IAS 2. Why abandon that?
It really boils down to that fundamental trade-off in accounting theory. Relevance versus reliability. Historical cost, yes, it's usually reliable, verifiable, you have invoices for feed, etc.
Right.
But is it relevant when dealing with biological transformation? Think about, say, a forest of trees planted 30 years ago. If you just track the cost of the saplings, fertilizer, maybe some maintenance over 3 decades, does that number tell an investor anything meaningful about the value of that timber today?
Probably not much, no. The value is in the grown trees, the timber volume.
Exactly. The whole point of these assets is that their value changes, often significantly, due to biological processes, growth, degeneration, procreation, production. Fair value aims to capture that economic reality.
So it's about showing the current worth, reflecting the biological changes.
Precisely. An investor looking at a cattle farm wants to know the value of the herd now, reflecting its size, weight, condition, and current market prices, not just what the feed cost last year. The IASB decided that for these specific types of assets, relevance providing useful, up-to-date information about the asset's current market worth actually outweighs the traditional comfort of purely historical cost.
Okay, I can see the logic.
Yeah.
But that must introduce challenges, right? And fair value sounds great, but how do you actually find a reliable fair value for, say, a sheep that's halfway through growing? It's not like they're traded on the stock exchange every day.
That's a very fair point. And it's where IAS 41 links implicitly to another standard, IFRS 13, which deals with fair value measurement in general. IAS 41 tells us to use market-based information where possible, and IFRS 13 gives us a hierarchy for that.
A hierarchy.
Yeah, 3 levels. Level 1 is the best quoted prices in active markets for identical assets. Think standard grades of wheat, or common types of mature livestock sold at auction. If you can get that, you use it.
Okay, the gold standard. What if that's not available?
Then you move to level 2. These are observable inputs, but not direct quotes for identical assets. Maybe prices for similar assets in active markets, or prices for identical assets but in markets that aren't very active. You might need to make some adjustments.
Right, still based on market data, but maybe less direct.
Exactly. And if you can't get level 1 or level 2 inputs, then you resort to level 3. These are unobservable inputs. This is where it gets more subjective.
How does that work?
If there's no market data, maybe you're farming a rare breed of alpaca, or growing a very specialized type of timber with no active market, you might have to estimate fair value using valuation techniques. Often that involves discounted cash flow or DCF projections, estimating the future net cash flows you expect that asset to generate and discounting them back to today's value.
Wow, okay, so if I'm raising those rare alpacas, I could be deep into level 3 inputs, making projections about future wool prices, breeding rates. That sounds quite subjective.
It absolutely is, and the standard acknowledges that. It accepts that some subjectivity might be necessary to achieve the primary goal, which is relevance. It's a trade-off. IAS 2, with its prudence focus, would likely shy away from that level of estimation for asset valuation. IAS 41 embraces it when necessary.
Okay, so the valuation method is different. Now, the scope of IAS 41 is also really important. We need clear definitions because the rules depend entirely on what kind of asset we're talking about. So first up, what exactly is a biological asset?
It's pretty straightforward, actually. A biological asset is defined as a living animal or plant.
Simple as that.
Yep. A herd of cattle, a flock of sheep, trees in a plantation forest, grapevines in a vineyard, fish being farmed, all biological assets.
Okay. And the crucial measurement rule for these?
They are initially recognized and importantly subsequently measured at each reporting date at fair value less costs to sell, FVCTS.
At each reporting date. So it's constantly being revalued.
Constantly updated, yes.
Yeah.
At the end of every reporting period, you look at the asset, determine its current FVCTS, and adjust its carrying value accordingly. We're always aiming for that current market valuation.
Okay. Then we have the other key term, agricultural produce. How is that different from the biological asset itself? People sometimes confuse these.
They do. Agricultural produce is the harvested product of the entity's biological assets. It's what comes from the living animal or plant.
Okay, examples.
Think milk from a cow, wool shorn from a sheep, logs cut from trees, apples picked from an orchard, grapes harvested from vines, the actual lambs born from the ewes. That's the produce.
Got it. And the measurement for the produce, is it the same FVCTS?
Similar, but with a critical difference in timing. Agricultural produce is measured at FVCTS only at the point of harvest.
Only at that specific moment.
Only at that moment. Let's use your dairy cow example. The living cow itself is the biological asset. It's measured at FVCTS continuously at every reporting date.
Right.
The milk, once it's actually collected from the cow, that's the agricultural produce, it gets measured at FVCTS at the moment it comes out of the cow and goes into the tank.
Okay, why that specific timing? Why not value the milk later?
Because that moment of harvest, that's the point where the biological transformation process ends for that produce. Once the milk is in the container, it's milk. Its value might change later due to storage costs, spoilage, or processing it into cheese, but not because of biological growth inside the cow anymore.
Ah, I see. Harvest marks the end of the IAS 41 journey for the produce itself. Hashtag tag 2.3, accounting for fair value gains and losses.
Exactly. And this leads us to probably the most striking difference compared to IAS 2. What happens when that FVCTS changes?
For the biological asset, you mean? The living cow.
Yes. If the FVCTS of a biological asset changes between reporting dates, maybe the cow got heavier or the market price for cattle went up, that change, whether it's a gain or a loss, is recognized immediately in the statement of profit or loss.
Wow. Okay, so no waiting for a sale like with IAS 2 inventory? If my cows get fatter or the price goes up, that's profit straight away.
That's profit straight away. Or a loss if values go down. This is IAS 41, recognizing the economic reality instantly. The farm is genuinely better off if its assets grow or increase in market value. So the standard says show that gain now.
And the gain can come from two different places, right? The animal getting bigger and the market price changing.
Precisely. The standard identifies two sources for the change in FVCTS, and both hit the SPL. 1. Physical change. This is due to growth, degeneration, production, like new lambs being born, or procreation, the animal getting fatter, the tree growing taller. 2. Price change. This is purely due to fluctuations in the market price per unit, like price per kilo of beef or price per cubic meter of timber.
And both of those components go into the P&L in the period the change happens.
Both of them. The total change in FVCTS goes to the SPL. Now, sometimes in exams, you might be asked to actually calculate and disclose the split between the gain from physical change and the gain from price change. It helps analyze performance.
Okay, could we run through a quick numerical example of that split? I think that would help solidify it.
Sure, good idea. Let's imagine a simple farm holds 100 young lambs at the start of the year, January 1st.
Okay, 100 lambs.
On January 1st, let's say each lamb weighs 20 kilograms, and the market price for lambs of that type is $5 per kilogram, fair value, less cost to sell.
Right, so the total value at the start is 100 lambs, 20 kilogram.
Yeah.
5 kilogram is $10,000.
Perfect. That's our opening value on the SFP. Now fast forward to the end of the year, December 31st. A couple of things have happened. The lambs have grown. They now weigh 30 kilograms each.
They got bigger. Physical change.
And the market price has also changed. Let's say it's increased to $6 per kilogram FVCTS.
Okay, price changed too. So what's the new total value?
New value is 100 lambs, 30 kilograms, 6 kilograms equals $18,000.
Right, so the total gain recognized in the P&L for the year is $18,000 minus the starting $10,000.
Yeah.
That's $8,000.
Exactly. An $8,000 gain hits the SPL. Now, how do we split that $8,000 between the physical growth and the market price increase?
How to do that?
Okay, first, let's isolate the gain purely due to physical change. We do this by calculating the change in value based on the weight increase, but using the original price, 5 kilograms.
Okay, so the weight increase was 30 kilograms, 20 kilograms equals 10 kilograms per lamb.
Right, so 10 kilograms increase per lamb, 100 lambs, 5 kilograms original price equals $5,000.
So $5,000 of the total $8,000 gain came from the lambs actually growing bigger.
Correct. Now, let's isolate the gain purely due to the price change. We do this by calculating the change in value based on the price increase, applied to the final quantity or weight, 30 kilograms to lamb.
Okay, the price increased from $5 to $6, so it's a $1 per kilogram increase. And the final total weight is 100 lambs, 30 kilograms, 3,000 kilograms.
Exactly. So no kilograms price increase, 3,000 kilograms from final weight equals $3,000.
Ah, I see. So the $8,000 total gain is made up of $5,000 from physical growth and $3,000 from the market price going up.
You've got it. And 5,000 plus 3,000 equals 8,000. It reconciles perfectly. Both components contribute to the total gain reported in the SPL. The journal entry for the total gain would be debit biological assets, SFP, $8,000, credit fair value gain, SPL, $8,000.
That split is really useful for seeing what's driving the performance. Was it good management leading to growth, or just lucky market movement?
Exactly. It provides much richer information. This immediate recognition really forces transparency about both operational efficiency and exposure to market risks.
Okay, so we understand biological assets and how gains losses are recognized. Now let's focus on that crucial transition point you mentioned earlier, the moment of harvest. This is where the asset stops being measured under IAS 41 and suddenly falls under the rules of IAS 2. Right.
That's the handover point. Once the agricultural produce is harvested, the wool is shorn, the apples are picked, the wheat is cut, the milk is collected. It gets measured for the very last time under IAS 41 rules.
And that measurement is at?
Fair value less cost to sell, FECTS, at that precise point of harvest. So you figure out what's the market price for freshly harvested apples minus any immediate cost to sell them right then, like brokerage fees, levies.
Okay, and that FECTS number calculated at harvest, what happens to it? Why is it so important?
Because that number becomes the deemed cost for subsequent accounting under IAS 2 inventory.
Deemed cost. Okay, explain that.
Think about it. IAS 41 has kept the value of the growing asset or the produce on the asset updated to its fair value. At the moment of harvest, that fair value represents the most relevant measure of the economic resource that's now entering the inventory stockpile. So IAS 41 effectively delivers the harvested produce to the inventory system at its current market value. That market value then becomes the starting cost figure for applying IAS 2's rules.
Okay, it's like IAS 41 sets the initial cost for IAS 2. Let's trace that. Say grapes are harvested. At the moment they are picked, their FECTS is calculated as $100 per crate.
Right. So debit agricultural produce inventory, $100, credit gain on harvest, SBL, $100. Or rather, this value comes from the final FE adjustment of the biological asset just before harvest. That $100 is now the cost of that crate of grapes under IAS 2.
Okay. Now, what if the farmer then takes those grapes and incurs more costs, say $20 per crate for storage and some initial processing to turn them into wine must, ready for fermentation? What's the IAS 2 cost now?
Good question. You add those subsequent costs, just like with normal inventory. So the new IAS 2 cost basis for that crate for wine must is the $100 deemed cost from harvest plus the $20 subsequent processing cost, totaling $120.
Okay, so the cost builds up, and from that moment on, that $120 cost figure is what we use for the IAS 2 test. Lower of cost, $120, and NRV.
Exactly. From the point of harvest onwards, the product is treated just like any other inventory. You apply the lower of cost and NRV rule at each subsequent reporting date.
So if, after all that processing, the market for wine must suddenly crashes, and the NRV for that crate drops to, say, $110.
Then the entity must apply IAS 2. Cost is $120. NRV is $110. Lower is NRV. They have to recognize an immediate write-down loss, $10, $110 in the SPL.
And crucially, once it's inventory under IAS 2, the entity can no longer recognize gains if the market price goes back up, right?
Yeah.
Only losses or reversals of previous losses up to cost.
That's the perfect illustration of how the standards work together but maintain their different philosophies. IAS 41 recognizes all the value changes, up or down, during the biological growth phase, delivering the product to the inventory stage at its current market value, FECTS at harvest. Then IAS 2 takes over with its prudence filter. Recognize any further decreases in value immediately, but don't recognize any subsequent increases above that deemed cost until the final sale.
Okay, that handover mechanism using FECTS at harvest as the deemed cost for IAS 2 is a really critical link to understand.
Absolutely essential.
Right, so we've hopefully established the core differences between standard inventory under IAS 2 and these living biological assets under IAS 41. But now we need to tackle the boundaries and the exceptions, because this is definitely where exam questions like to introduce complexity, often by bringing in another standard, IAS 16, property, plant, and equipment.
Yes, the exclusions and boundaries are vital. Get these wrong, and you apply completely the wrong measurement basis. Hashtag 3.1, the bearer plant exception, the IAS 16 crossover. And the biggest, most notorious boundary issue is the bearer plant exception. This is probably the single most common area of confusion and error for students when dealing with IAS 41.
Okay, bearer plants. So
Sure.
when is a plant not a biological asset under IAS 41?
It's when the plant stops being primarily the thing you harvest itself and instead becomes more like a piece of living machinery used to produce something else.
Like a factory machine, but alive.
That's a great way to think about it. A bearer plant is defined as a living plant that meets 3 specific criteria, and you need all 3 for it to be kicked out of IAS 41 and into IAS 16.
Okay, what are the 3 magic criteria?
Right, criterion 1. It must be used in the production or supply of agricultural produce. So an apple tree produces apples, a grapevine produces grapes. It has a production function.
Makes sense. Criterion 2.
It's expected to bear produce for more than 1 accounting period. It's long-lived in its production cycle, not like a wheat plant that produces 1 harvest and is gone.
Okay, used for production, lasts multiple periods, and the third one.
This is often the clincher. It must have a remote likelihood of being sold as agricultural produce itself, except maybe for incidental scrap sales at the very end of its life.
Remote likelihood of being sold as produce. So the farmer isn't in the business of growing and selling the trees themselves, only the fruit from the trees.
Exactly. If you run an apple orchard, your business is selling apples. You might eventually chop down old trees for scrap wood, but that's incidental. Your primary purpose for the tree isn't to sell the tree. Contrast that with trees being grown specifically for lumber. Those trees are the agricultural produce, so they remain under IAS 41.
Okay, so the 3 tests are used for produce, bears for multiple periods, unlikely to be sold as produce itself.
Get all 3 yeses, and it's a bearer plant. Classic examples are those apple trees, rubber trees you tap for latex, tea bushes, grapevines, oil palms.
And if it is a bearer plant, what happens? It's excluded from IAS 41. So where does it go?
It gets accounted for under IAS 16, property, plant, and equipment, just like a factory building or a piece of machinery.
Wow. Okay, so what does that mean for the accounting treatment compared to, say, trees grown for lumber under IAS 41?
Big difference. Under IAS 16, the bearer plant is initially recorded at cost, what you paid for it or cost to cultivate it to maturity. Then, critically, it is depreciated over its estimated useful productive life.
Depreciated, like a machine.
Exactly. You're systematically allocating the cost of that living machine, the tree or vine, over the periods you expect it to produce fruit or sap. You're matching the cost of the asset against the revenues generated by its produce. It's back to historical cost principles.
Whereas the IAS 41 assets, like the cattle or the trees grown for lumber, they're measured at FECTS and are never depreciated, right?
Correct. Because their value is constantly being updated to fair value, depreciation doesn't make sense. The change in fair value captures the economic change. But for the IAS 16 bearer plant, we depreciate its cost.
Okay, this really clarifies the whole agricultural picture then. Let me see if I have this right.
Go for it.
The apple tree itself, assuming it meets the 3 criteria, is a bearer plant. So it's under IAS 16, capitalized at cost, then depreciated over its life.
Right.
The apples growing on that tree, while they're growing, they are agricultural produce still attached to the bearer plant. Now, this is subtle. The standard says the produce growing on bearer plants is within the scope of IAS 41, so it's measured at FECTS as it grows.
Yes, that's an important clarification. The fruit itself is IAS 41 until harvest. The tree is IAS 16.
Right, and then once the apple is picked from the tree, harvested.
It leaves IAS 41, its FECTS at harvest becomes its deemed cost, and it becomes inventory under IAS 2, subject to the lower of cost and NRV test from then on.
Tree, IAS 16. Apple growing, IAS 41. Picked apple, IAS 2.
Wow. That's the flow you absolutely have to master. It brings all 3 standards together.
Okay, but what about What if things change? You mentioned the remote likelihood of sale criterion.
Yeah.
Say the bottom falls out of the apple market and the farmer decides, forget the apples, I'm going to chop down these mature trees now and sell them as timber. Does the tree suddenly switch back to IAS 41?
That's an excellent challenge question, and yes, the classification can change. If the farmer's intention changes and the likelihood of selling the plant as produce, in this case timber, is no longer remote, then the plant ceases to be a bearer plant.
So this stops being IAS 16.
It stops being IAS 16. It would typically be transferred out of IAS 16 PPE and into the scope of another standard at that point. Now, which standard? Since a living plant intended for harvest, as timber, it would likely be reclassified as a biological asset under IAS 41, measured at its FVCTS at the date of reclassification.
Okay, so it jumps back to IAS 41 briefly.
Potentially, yes. Or, if the decision is to cut it down immediately for sale, it might effectively transition straight from IAS 16 to IAS 2 inventory as logs, with its carrying amount from IAS 16 perhaps being compared to FDCTS to determine the initial inventory cost or any impairment needed at the point of reclassification. The key is, the IAS 16 treatment stops when the bearer plant definition is no longer met, particularly that remote likelihood of sale test. Hashtag tag 3.2, other key exclusions from IAS 41 scope.
Okay, the bearer plant is the big one.
Yeah.
But we need to keep a few other exclusions from IAS 41 straight as well, because they often pop up as distractors in exam questions trying to test if you know the scope.
Absolutely. There are 3 other key ones to remember.
Go on.
First, the land related to agricultural activity. The fields, the pastures.
Where does that go?
That falls under IAS 16, property, plant, and equipment. Land is usually not depreciated, of course, but it's accounted for under IAS 16 rules. Or potentially, if it's held purely for capital appreciation or rental, maybe IAS 40, investment property, but usually IAS 16 for farmland, definitely not IAS 41.
Okay, land is IAS 16. What else?
Second, intangible assets related to agricultural activity. Things like milk quotas, fishing licenses, specific production rights. These aren't living assets themselves, they're legal or contractual rights.
So they're intangibles.
Yep, they fall under IAS 38 intangible assets and are usually amortized over their useful lives if they have finite lives.
Right, IAS 38 for intangibles. And the third exclusion.
Government grants relating to agricultural activity. Now, the grant itself isn't excluded from recognition, but the accounting treatment specified by IAS 41 is different from the general grant accounting standard, IAS 20.
How so? I thought grants were usually recognized over time, matched with the related expense or asset depreciation.
That's the usual IAS 20 approach for grants related to assets, like bearer plants under IAS 16 or specific expenses. But IAS 41 has a specific rule for grants related to IAS 41 biological assets measured at fair value. It says you recognize the grant income in the statement of profit or loss immediately when the grant becomes unconditionally receivable.
Immediately. No deferral, no amortization.
Generally, no. If the grant relates to a biological asset measured at FVCTS and the conditions attached to the grant have been met, the income hits the SPLs straight away. It's another example of IAS 41 favoring immediate recognition of economic benefits.
Wow, okay, that's a classic exam trap then. They give you a grant related to livestock and expect you to apply the normal IAS 20 deferral rules, but the IAS 41 rule overrides it.
Precisely. Immediate income recognition for grants related to FVCTS biological assets once receivable. Hashtag 3.3 consolidating conceptual differences.
Okay, this has been incredibly helpful in drawing the lines. So let's just take a moment to consolidate the really core conceptual and measurement differences between these key standards we've touched on. IAS 16 for things like bearer plants and land, IAS 41 for the living biological assets, and IAS 2 for the inventory, including the harvested produce. Understanding how they contrast is surely key.
Absolutely. Let's try and summarize the critical philosophies and mechanics.
Okay, start with IAS 16, property, plant, and equipment, which covers the bearer plants and the land. What's the philosophy and measurement there?
The philosophy is generally historical cost accumulation and systematic allocation of that cost over the asset's useful life, except for land. So the measurement is either the cost model, cost less accumulated depreciation and impairment, or the revaluation model, fair value less subsequent accumulated depreciation and impairment. And crucially, for depreciable assets like bearer plants, you depreciate them. It's about matching the expense of using the asset to the periods it generates benefits.
Right. Historical cost focus. Depreciation is key.
Yeah.
Now, IAS 41 agriculture for the biological assets like the growing cattle or trees for lumber.
Here, the philosophy shifts entirely to relevance and reflecting biological change. The measurement is fair value less costs to sell, FVCTS, remeasured at every reporting date. Gains or losses arising from changes in FVCTS, both physical changes and price changes, hit the statement of profit or loss immediately. And importantly, these assets are not depreciated.
Total contrast. Relevance, fair value, immediate P&L impact, no depreciation. Okay, finally, IAS-2 inventory, covering regular goods and also the agricultural produce after it's been harvested.
Back to the philosophy of prudence. Measurement is strictly the lower of cost, which might be actual cost, or the deemed cost from IAS 41 at harvest,
Right.
and net realizable value, NRV. The focus is firmly on preventing the overstatement of assets by recognizing expected losses instantly. No recognition of unrealized gains above cost.
That summary really crystallizes it. IAS 16 is about cost allocation over time. IAS 41 is about current value and immediate recognition of changes. IAS 2 is about conservative valuation, capping value at cost and recognizing losses below cost.
That's a perfect way to put it. And that difference, particularly the instantaneous recognition of gains and losses under IAS 41 versus the much more cautious deferred recognition approach under IAS 2, is probably the single most important conceptual hurdle for students to get over. It explains why the rules are so different. They're prioritizing different qualities of financial information based on the nature of the asset involved.
It also highlights, doesn't it, how much judgment can be involved, even with these rules.
Absolutely. Estimating NRV under IAS 2 requires judgment about future selling prices and costs. Estimating FVCTS under IAS 41, especially when you get into those level 3 unobservable inputs like DCF models, involves significant estimation and subjectivity about future yields, prices, discount rates. Financial reporting isn't always black and white. It's often about applying principles and making reasoned judgments. #outros.
Well, this deep dive has really, I think, hammered home why you need to understand the actual philosophies behind these standards, not just rote, learn the rules. IAS-2 is, well, it feels quite rigid, focused on those verifiable costs, ensuring prudence kicks in immediately, making sure manufacturers only report profit when it's essentially locked in through a sale.
Yeah, it's the cautious accountant standard in many ways, whereas IAS 41, it prioritizes speed and relevance. It wants the financial statements of a farm or a forestry company to reflect the often rapidly changing economic reality of biological growth and volatile market prices the moment those changes happen. Hopefully you, the listener, now have the tools to understand why we have things like the normal output test in IAS 2 and why IAS 41 uses FVCTS. It's about understanding the reasoning.
It really is. And understanding those differences raises a really interesting final question for you, our listener, to think about. We've established that the farmer operating under IAS 41 faces potentially quite volatile profits reported in their P&L, because those fair value changes hit immediately, even if they're driven by market prices outside the farmer's control.
That volatility is inherent in fair value accounting for biological assets.
So here's the thought. What does that volatility mean for the farmer's ability to, say, access financing? Compare them to a stable manufacturer using IAS-2, whose reported profits based on historical costs and sales might be much smoother and more predictable. Does the very real, relevant, but volatile profit figure reported under IAS 41 potentially make it harder for that farmer to get bank loans or meet debt covenants compared to the manufacturer, even if the farmer's underlying business is just as fundamentally sound or even growing faster economically?
That's a fantastic point to ponder. It's a real-world implication. Does the better information from a relevance perspective under IAS 41 actually create practical challenges in areas like financing? Because lenders often prefer predictability. The volatility might indeed scare off more cautious lenders or require different types of loan covenants, even though the IAS 41 numbers arguably give a truer picture of current economic performance and position. It certainly requires the users of those financial statements, the banks, the investors, to be more sophisticated in understanding the nature of agricultural risk and how fair value accounting reflects it.
Something definitely worth considering beyond the exam syllabus. Okay, and that wraps up our deep dive today, focusing on IAS-2 inventory and IAS 41 agriculture. Remember, this deep dive is just one part of the SmartPass podcast series. We designed these specifically to help you succeed in financial reporting by breaking down these complex rules into clear, practical knowledge you can actually use.
Absolutely. Keep an eye out for more deep dive FR topics coming your way soon, and definitely check out the video description. You'll find links there to the SmartPass study resources. Our interactive notes, the practice tests, they're packed with examples and questions covering exactly these kinds of calculations and concepts for both IAS 2 and IAS 41.
They really are invaluable for practice. And please make sure you subscribe to the SmartPass YouTube channel for more expert-led, exam-driven learning designed to get you through your ACCA exams. Thanks for joining us, and we'll see you next time for another deep dive into the world of financial reporting.